Hi everyone, Martin Bamford here. I'm a chartered financial planner at Informed Choice, and the Chancellor of the Exchequer, Rishi Sunak, has just spoken in the House of Commons this lunchtime. He has announced an extension for the furlough scheme through to the end of next March. Yes, we're having a year of furlough. So in this video, I just want to go through that announcement, with the changes to a furlough scheme, what we can expect over the coming months, and also the big news this morning from the Bank of England's Monetary Policy Committee, their huge extension to their bond buying programme of quantitative easing, as well as some quite worrying economic forecasts. So I want to look at all of this, what it means for your money. So the Chancellor spoke in the House of Commons at lunchtime today. He announced the furlough scheme, the coronavirus job retention scheme, is being extended all the way through until the end of March 2021. And this, of course, is in response to the latest lockdown measures, the latest restrictions as a result of the coronavirus. So Rishi Sunak saying that if you're placed on furlough, that is going to be at 80% of your current earnings, up to a cap of £2,500 a year. So the 80% coronavirus job retention scheme being extended through to the end of next March. The government will pay the 80% as things stand. All that employers will have to contribute towards furloughed employees will be employer national insurance contributions and employer pension contributions, the minimum required pension contributions. Now, we don't know for sure whether this 80% furlough is going to last all the way through until the end of March. Rishi Sunak did say it's going to be reviewed in January, and there's a very good chance during that review that employers will be asked to contribute more. In fact, I predict right now that is what will happen, that between January and the end of March we'll see a gradual increase in the employer contribution. So it becomes 70% from the government, then 60% before it closes, so employers having to pay more. But however, we do think this is going to be flexible furlough like it is right now, and that means that employees can come back on a flexible or part-time basis as long as they are either furloughed entirely for a number of weeks. I think it's 2 weeks currently. Then they can qualify and claim for furlough on that basis, or they can do part-time hours and the government and the employer can share the cost of that employee. Now, one big implication of the furlough scheme being extended through to the end of March is that the job retention bonus that was due to be paid at the end of January, that's a £1,000 bonus for employers who brought back staff who were previously furloughed. That is no longer on the table. So Rishi Sunak effectively scrapping that job retention bonus of £1,000, but saying it's likely to be redeployed later should circumstances permit that. The other knock-on implication of this extension to the furlough scheme is that the self-employment income support scheme, the grants for self-employed people, are also going to be updated and increased. So whereas before they were going to be 80% of net profits for the period of the lockdown, the 5th of November through to the 2nd of December, it's now going to be 80% for the entire period, this 3-month period, up to a cap of £705,000 for the 3-month period. So the self-employment income support scheme broadly reflecting the coronavirus jobs retention scheme, or furlough. That's where we're at then with the latest from Rishi Sunak, but it followed hot on the heels of a Bank of England Monetary Policy Committee meeting this morning, or at least an announcement from the Monetary Policy Committee this morning. They've been meeting over the past couple of days, and normally we get Bank of England announcements at lunchtime. We normally get them around midday. This morning the announcement came out at 7 a.m, so before markets opened, and the reason for that was that the Bank of England really firing off their big bazooka when it comes to quantitative easing, printing money to buy bonds. Now, many economists predicted the Bank of England would print £100 billion of extra quantitative easing to buy bonds. They went further than that. They printed £150 billion worth of new money to buy bonds with. Now, not going to deploy that money all at once. The bank thinks that will last them through to the end of 2021, so it will be gradually used to buy bonds. And almost immediately, we saw the price of pound sterling go up. We saw bond prices go up. So the market reacting very positively to the Bank of England's extension to its QE programme. The other announcement this morning from the Bank of England when it came to monetary policy was the decision to keep interest rates on hold at their historic low of 0.1%. And interestingly, all nine members of the Monetary Policy Committee voting to keep interest rates on hold. So a unanimous decision from the MPC. There was no dissension. There was nobody hinting towards a further rate cut. In the past few months, we've heard lots about negative interest rates. And it appears from the minutes I've read this morning from the Bank of England, negative interest rates not really being mentioned anymore. That could be because banks are weighing up the practical implications of negative interest rates, and they need a bit more time to work out how they would work commercially, how they would apply them to customers. Or it could be the Bank of England realising that negative interest rates really won't have much of an impact, which is my belief. I don't think we'll see negative interest rates, but this huge extension to bond buying, I think, was the right move at this time to support markets. Now, also from the Bank of England today, we saw an update to their economic forecasts for the whole of this year, the whole of 2020. The Bank of England now believes that the UK economy, GDP, will contract by 11%. So that's a worse position than their previous forecast of 9.5% for this year in terms of contraction. The Bank of England also believes that we will see economic recovery next year, but at a slower rate of growth before. So they're talking about a slower, bumpier economic recovery. And it won't be until the first quarter of 2022, based on their current forecasts, that the Bank of England believes the UK economy will exceed the size of its pre-pandemic levels. So it will take until the first quarter of 2022 to go back. The bank also forecasting that unemployment will peak by the middle of next year at 7.75%, up from its current level of 4.5%. That will be the highest unemployment rate for the UK since 2013. And of course, this week we've seen news of more job losses. So today it was Sainsbury's, yesterday Lloyds Bank and John Lewis. Multiple job losses, thousands of job losses across some of these big employers as the economic situation becomes even more dire. But that dire economic forecast is why the Bank of England has pumped so much money into the bond market. It's why Rishi Sunak stood up in Parliament today and announced an extension to furlough at 80% through to the end of March. That's what's going on today. That's what we know is happening. Of course, some big risks ahead. We don't know for how long this current lockdown will last, how bad this second wave of coronavirus will be. We've still got uncertainty in the US with the results of the presidential election unknown right now. And of course, we've still got this looming Brexit deadline coming up, 31st of December. That is the end of the transition period, at which point, if we don't have a trade deal, we could have some very, very choppy economic times ahead, at least in the short term. I hope you found that useful. Let me know what you think in the comments down below. What do you think of the extension to furlough and the self-employed grants? What do you think of the Bank of England pulling the trigger on this big QE bazooka? And what do you think about their economic forecasts, which do appear to be worsening? Let me know down below. Please do subscribe to this channel. Thank you for your support. I'm Martin Bamford. Until next time, remember, when it comes to your money, the more you know, the faster it can grow.